Hello YouTube. So let's look at what happens when a market basically reprices an area and there's a lot of volume at this particular zone. So this market EUR so it ran up and then it kind of consolidated and then it continued higher. So if we look here, we see the market, it ran up and then it took a little break. Right? It dipped down lower, and then we had about 2 days of consolidation, and then when it ran up, it did a few things that you can use in your trading. So basically, as the market ran down, you can see this point of control here. It's quite significant, and then it left a small little tail here to the buy side, and then it basically did the same thing. So the general idea is when the market is done with an area, the value moves up, but it's how it happens. So if you identify your point of controls as basically where you see your heavy volume, essentially. So let's call the point of control a high volume node. Right? So we have one here, and then we have one here, and then we have one here. Right? So if you look, every time we see the market leaving a heavy high volume node, it leaves the tail, and the tail has low volume, right? So essentially what you're looking for is that, yes, you're trading in the zone, but when it breaks, it closes on the high essentially, and we're looking for a retest and then a continuation. So in a sense, it's harder to see it in this time, but here, right? So a decision was made, right? So here we go. A was printing, and then all the way at little e, that's when the decision was made, right? So you can see it repriced. The market didn't really do a whole lot for a couple hours, and all of a sudden it left the high volume node, and then it shifted back into its trending phase, right? So, and then you'll notice that these are excess, like this little e here, that's actually an excess. You just don't see it as well because it's inside the profile itself, and that is a decision essentially, right? So if the market were to return to that area, right, and you can see F tried to, right, because it was the next 30-minute period, it got rejected again because there was buyers coming in, right? So like if you're standing on the floor in the pit, right, you would say, oh, we have a new bidder, right? It's kind of like an auction idea, right? So essentially whenever you see it, like you can find another good example. So when the market shifts down again, like here, it repriced this zone a little bit in this day, and then we had kind of an inside day, and then the longer time frames were not involved in this day, right? But we can see, and we know that the longer the consolidation, the bigger the breakout, right? But we can see the market shifted down, right? And then see, like consolidation, we have a distinct shift in the market, right? So we see like a clear rejection, right? It's like a decision was made, essentially, right? So you can see it again all over the place. So like here, so it repriced this area, and again, inside day, repriced this area, and then here. Like this isn't as obvious, but it's the same thing. So, and when the market leaves, it leaves these tails. So when I say low volume node, I'm not looking at my volume profile. I'm just looking at how many prints there are, right? So like if those eyes there, if there was like 8 in a row and there wasn't anything beside to the right of it, then I would know, well, that's a clear decision in the market, right? So it's these decisions that you can understand that, well, okay, now we shifted into a trend, right? And once we understand that, then we're like, okay, well, now it's a brand new trend, right? Because you can see the gap, right? So it's like they say, okay, why would you buy something for $20 when you could pay $12 for it yesterday, right? Well, there's actually less risk, but again, it's trade location. So really, like your risk and opportunity is defined by your trade location. So like, if you were to say take a trade in here, well, that's not as good as taking a trade down here. That's not to say you have to trade down at the low, right? But your risk is so much less, right? And in addition, there's a whole time frame aspect to it, right? So if you know that the market, in order to go higher, has to go lower first to pick up, whether it be stops or just limit orders that are sitting from they're left by the higher time frames, then you can understand, okay, well, I can see like an anomaly like here, that little tiny X, like that's kind of like a rough edge, same as like here and here. So I'm interested in like this area, right? And when you know it, comes back down, it stays one tick above this little X, but I'm interested in this area, right? So you'll see this all over the chart, and you'll see elongation. And like just looking at this profile, like it is a P-shaped profile, so it kind of looks like short covering, but it's not, because see how the market, it opened down on the low side of things, right? And then we have elongation and we have good volume to the upside, right? So now we're accepting higher prices. There's no shorting happening here, right? Now, if this was at the top of the trend and we seen this, well, that would be a different story, right? So hopefully this makes sense with the high volume nodes. Is basically, it usually lines out to be your point of control anyway, but it doesn't necessarily have to be, right? The point of control is just the fairest price for the whole day or session or whichever the profile is built on.